The SPDR S&P 500 ETF Trust had a strong day today, Wednesday, May 6, 2026, gaining 1.12% to close near $731.89. The market pushed toward new record highs, primarily driven by a surge in technology stocks and positive geopolitical developments. Market performance summary. SPY price action opened at 728.15 and reached a high of 732.49. Major indices. The Nasdaq 100 QQQ outperformed with a 1.63% gain, while the S&P 500 overall rose by about 1.37%. Key drivers. NVIDIA, NVDA, led the charge with a 4.65% jump, continuing the AI-driven momentum. AMD saw a massive 18.11% rally following strong sector sentiment and earnings optimism. Top market news. U.S Iran Ceasefire. Markets rallied as reports of a potential peace deal between the U.S. and Iran held firm. This geopolitical de-escalation significantly lowered oil prices, which plunged nearly 10% on the day, easing inflation fears and boosting equities. Earnings season. Strong corporate earnings continue to defy broader economic concerns. Analysts noted that the current earnings season is proving resilient despite recent volatility. Economic outlook. Apollo chief economist Torsten Slok shared an optimistic view today, suggesting that AI will serve as an engine for job growth rather than a cause for mass layoffs, which provided further tailwinds for tech stocks. Samsung joins 1T Club. IN Global News. Samsung Electronics stock has doubled this year, making IT the second Asian company, after TSMC reach a $1 trillion market cap. Technical sentiment. The market remains in a risk-on mode. While some analysts warn that the S&P 500's price-to-earnings ratio is approaching historically high levels, surpassing 30 in some metrics, the immediate trend remains bullish with strong technical buy ratings across major ETFs. Looking ahead to the rest of May 2026 and the coming months, the outlook for the SPY and the broader market remains cautiously optimistic, with many analysts eyeing a run toward the $760 range by year-end. Here is what is on the radar for the next few weeks. 1. High-stakes economic data. The biggest catalyst for May is the Consumer Price Index, CPI report, scheduled for May 12th. The goal. Markets are looking for a softer reading. Inflation has been sticky throughout early 2026, keeping interest rates higher for longer. The impact. A cooler inflation number would likely solidify a June rate cut from the Federal Reserve, which could push SPY past current resistance levels. 2. Technical targets and support. Upside resistance. Analysts see a technical target between $740 and $750 if the current momentum holds. Downside support. If the rally stalls, the first major support floor sits at 717. A deeper pullback could see the index test its 200-minute stay moving average, currently hovering around *682. Golden star signal. Technical analysts are pointing to a rare golden star alignment, where short and long-term moving averages align perfectly, that occurred in February, which historically suggests double-digit gains over a 9-month horizon. 3. The Phase 2 inches AI rotation. We are shifting from Phase 1 inch, buying hardware like NVIDIA chips, to Phase 2 inches, companies actually making money using AI. Sector rotation. Keep an eye on healthcare, logistics, and finance. Investors are starting to rotate capital into these adopter sectors as they use AI to slash costs and boost margins. Broadening breadth. While big tech has carried the market for years, 2026 is showing signs of a marathon broadening where industrials and cyclicals are finally joining the party. 4. Key risks to watch. Oil prices. While the recent ceasefire news helped, any reversal that pushes crude back toward $120 per barrel would act as a tax on consumers and could reignite inflation. Valuation fatigue. The S&P 500 PE ratio is currently brittle. If upcoming earnings from late reporting companies don't justify these high prices, we could see a sell-the-rip mentality take over. The market sentiment has shifted decisively today, moving from neutral to firmly into greed territory. As of this afternoon, May 6, 2026, the CNN Fear and Greed Index sits at 67.3. This move is a sharp rebound from the fear levels we saw earlier this spring, and it signals that investors are once again prioritizing growth over safety. The current pulse, greed, 67.3. Sentiment metric, current status, insight, market momentum, extreme greed. The S&P 500 is trading significantly above its 125-day moving average. Stock price breadth, greed. The rally isn't just big tech anymore. The volume on advancing stocks is outpacing declining ones. Safe haven demand, fear. Investors are dumping bonds and gold. Gold dropped to approximately $4,681 today to chase stock returns. Market volatility, VIX, neutral. The fear gauge is low, but not at the complacent lows that usually precede a crash. Strategic insights. 1. The crowded trade alert. With the index approaching 70 plus, we are entering the zone where the market becomes overbought. Historically, when greed hits these levels, the risk/reward ratio for new long positions starts to degrade. If you aren't already in, chasing the current $731 level on SPY might be buying the top of a short-term cycle. 2. The geopolitical sugar high. A large portion of today's greed is fueled by the U.S. Iran ceasefire reports. Sentiment is currently pricing in a best-case scenario for energy prices. If these negotiations hit a snag, that greed score of 67 could evaporate instantly, leading to a rapid mean reversion, a dip back to neutral. 3. Crypto as a leading indicator. Interestingly, the Crypto Fear and Greed Index just hit 50, neutral today, ending a 108-day streak of fear. This suggests that while stock traders are already greedy, the more speculative retail crowd is only just now starting to feel safe again. This often precedes a secondary wave of liquidity entering the stock market. The bottom line, the fear of missing out, FOMO, is currently stronger than the fear of losing money. This environment favors trend following, but it is also the exact time to tighten your stop losses. Pro tip, watch the put/call ratio. If it drops below 0.80 this week, it means traders are becoming dangerously lopsided with bullish bets, usually a sign that a contrarian dip is around the corner. Right now, we are in a swing trader's paradise, but it's becoming a minefield for long-term investors looking for new entry points. Here is the breakdown of how each style fits this specific 2026 market environment. 1. Swing trading, the sweet spot. This is currently the most viable strategy. Why? The market is trending strongly, but it's doing so in stairs, sharp rallies followed by 3 to 5 day consolidations. The play, with the Fear and Greed Index at 67, swing traders are looking for mean reversion plays. You wait for the SPY to pull back to its 20-day EMA, exponential moving average, and buy the bounce. Risk. The danger here is gap risk. With geopolitical news, like the ceasefire, driving the tape, a headline at 3 a.m. can cause the market to open 2% higher or lower than where you went to bed. 2. Day trading. High octane, low certainty. It is a viable day trader's market, but only if you have the stomach for volatility. Why? Average true range, ATR, which measures how much a stock moves daily, is elevated. This provides the meat on the bone that day traders need to scalp profits. The challenge: high-frequency trading, HFT algos, are currently very aggressive around the $730 SPY level. We are seeing fake-out breakouts where the price pops above a level and immediately slams back down. Best setup: momentum scalping in the first 90 minutes of the session. After that, the midday fade has been brutal lately. 3. Investment market. Long-term hold, short-term wait. For the long-term investor, this is a difficult time to put fresh capital to work. The valuation gap. With the S&P 500 PE ratio pushing past 30, you aren't exactly buying at a discount. Investing here requires you to believe that AI-driven productivity gains will justify these prices 2 years from now. The strategy: if you're a long-term bull, this is a DCA, dollar cost averaging market, not a lump sum market. The insight: most institutional smart money is currently holding what they have invested, but aren't aggressive buyers at these highs. They are waiting for a healthy correction, roughly 5 to 7% to rebalance. The verdict: strategy, rating, recommendation, day trading, B+. Great for those who can trade the open, dangerous for those who overtrade the afternoon. Swing trading, A. The trend is clearly up, making buy the dip highly profitable over 5 to 10 day windows. Investing, C. High risk of buying the top in the short term. Better to wait for a cooling in the greed index.